So what should they do? Limited liability companies are the most popular form being used today to start up businesses and conduct businesses. Why? They're easy to form. They're really flexible. They can do anything. A limited liability company can be disregarded for income tax purposes if one person owns it. So all the income and expenses get reported on Schedule C of the tax return. They can be treated as a partnership if 2 or more people own it for tax purposes, which is a really flexible business vehicle, a partnership, but very complicated. And there are lots of opportunities in doing planning with the partnership tax form, but it's a limited liability company. So it offers all of the owners, all of the members, limited liability. It's flexible in that it can be an S corporation. A limited liability company can elect, just by filing Form 2553, to be taxed as an S corporation. Did you know that? A lot of you, I'll bet, didn't. And that's something, again, keep it in the back of your mind. The problem with these is they're so ubiquitous and so easy to set up that everybody goes onto LegalZoom or they get their CPA to do it and they screw it up. And so we end up cleaning up a lot of that. I'll give you an example. Brian and I worked on a transaction where it was a limited liability company. They elected S corporation status. Their lawyer who set them up originally was not a tax lawyer and put them into an operating agreement format that was a partnership template. So it was a partnership, but they elected S Corp status. Well, if we hadn't fixed it before the transaction was to close, they would have jeopardized their S Corp election, and they would have lost their S Corp election because the partnership template of operating agreement automatically violated the S Corp rules the way it was drafted. So unless you go to a tax lawyer or a tax CPA who really knows what they're doing, you get into trouble. So go to a lawyer, have them help you set this stuff up. Sometimes it's hard to administer. Lars, you and I know what that's like, right? We're dealing with some of these issues right now, but we're learning and we're fixing it and we're figuring out what the best structure and the best strategy is. Corporations. Everybody used to set up a corporation. That was the way we went. We'd contact our lawyer, have them draft articles of incorporation, bylaws, organizational minutes, and maybe a shareholders agreement if there were 2 or more shareholders. And we're off and running. The corporation is probably least used today because it's so rigid in the way it has to be structured, although, believe it or not, it can be flexible too. So for example, corporations have shareholders, and they have a board of directors. And they typically have officers. So the shareholders own the entity, the board of directors manages the entity, and the officers run the day-to-day operations of the entity and report to the board of directors. Did you know that in Virginia, you can elect to waive and eliminate the board of directors? There's a statute. It's very flexible. So the shareholders own it and are responsible for managing it, and then they can elect the officers directly. It's kind of like Maryland, which has a close corporation statute, which also does away with the boards of directors. In my opinion, I think it's better to have that segregation of duties, even though it's a little bit more complicated, because it really enhances the limited liability that you get by being in a corporate form. And that's what corporations do provide, is a long history of corporate law and what it means to have limited liability and the doctrines that underlie that. So when can a creditor come in and pierce the corporate veil and go after shareholders? There's a lot of law, particularly in Delaware, that defines what that is. But we don't use them very much because they're subject to double taxation. If you are a C corporation, which is subchapter C of the Internal Revenue Code, all the income that comes in is taxed at rates up to 35%, although Trump is threatening to lower that rate way down. And then the distributions out of that corporation of profits are taxed again to you as the shareholder at rates up to 20%. So it's double taxation. And when you sell the company, Most companies want to buy assets. The buyers want to buy the assets. The sellers want to sell the stock. But the buyer wants to write up the tax basis of the assets when they buy them. If they're going to buy the stock, they can do that. There's something called a 338 election. How many of you have heard of that in your time out there? 338. Well, it's a code section that was enacted to allow buyers to treat stock sales like asset sales, so they can write up the tax basis and write it off as goodwill over 15 years. So they get a tax deduction for it. Well, if you're in a C corporation, you don't get that benefit. You're going to have this double taxation. It's harsh. So a lot of people elect S corporation status. They'll incorporate and they'll file their S corporation election, and they're off and running. There's only one level of tax usually. There are exceptions to that rule, by the way, because if you started as a C corp, you may have double taxation on built-in gains and other nuances. But S corps generally are subject to one level of taxation. It's the most popular form of entity today, but a lot of limited liability companies are electing S status. So keep that in the back of your mind. And again, how do we differentiate these? This is just a tax designation. But for corporate law purposes, if it's a corporation, it's always treated the same. Any questions on this? Choice of entity is really key. When I use C corporations, I usually limit it to companies that are seeking outside equity financing, venture-backed investment, private equity, angel investors, because they usually have the types of investors like tax-exempt entities or pension funds or endowments of educational institutions that demand that it be operated in a C corporate status so that they don't get taxed on the earnings and have to pay a 35% flat tax on it. Choice of entity is really important, and so you want to know what your options are. There are other forms of entities. The partnership form is not used as commonly anymore because LLCs are in existence. LLCs came about, the first LLC in the United States, the first statute was in 1987, and that was Wyoming that did that. Virginia enacted its first statute, 1995. Maryland, DC followed in 96, 97, or thereabouts. So it's only been around for about 20 years. And it's in all 50 states. So people used to use the partnership form in lieu of using LLCs. Now they're using LLCs. In some states, you still use partnerships, like Texas. So you'll see a lot of oil and gas entities formed as limited partnerships. And the limited partnership always has a general partner. The general partner has unlimited liability for the liabilities of the entity. The limited partnership has a general partner, and the general partner has unlimited liability. So it's the states, because of lobbying from lawyers and others who operate in this type of form, formed something called a limited liability limited partnership, an LLLP. How many of you have seen that around? I mean, I've formed them. That takes the general partner and makes it into a limited partner so that they no longer have unlimited liability. There's also LLPs. So all the big accounting firms are now LLPs, and the big law firms are LLPs. What that does is it says your liability is limited to your own malpractice and those that you supervise, but you're not liable for the guy that committed the Enron debacle. That's what led to the demise of Arthur Andersen and Company, where he started his career and I started my career almost 36, 37 years ago. A very good firm that got brought down by 5 or 6 partners in Houston. And the firm was operated as a partnership, a general partnership. And as good as they were, they didn't realize that they potentially had exposure for all of these liabilities. So limited liability, limited partnership, limited partnership, limited liability partnership, and then trusts. We use trusts in business all the time. How do we use them? We might use an irrevocable trust as the manager of an LLC. An irrevocable trust has limited liability protection for all of its beneficiaries and for the trustee, as long as the trustee is exercising his or her fiduciary duty properly. The trust can provide limited liability protection for the assets in the trust, so creditors can't get at it, and they can't get at the beneficiaries or their assets either.